You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Today's podcast is sponsored by Mint Mobile. Get your new customer offer and your new 3-month unlimited wireless plan for just $15 a month at mintmobile.com/gold. Additional taxes, fees, and restrictions apply. See Mint Mobile for details. Today's podcast is also sponsored by Shopify. Shopify is a platform designed for anyone to sell anywhere, giving entrepreneurs like myself the resources once reserved for just big business. Sign up for a $1 per month trial at shopify.com/gold, all lowercase.
The Peter Schiff Show.
Hi, everybody. I am back here in Connecticut. This is the first podcast that I'm doing since number 1000. This is 1001. It's also probably the last podcast I'm going to do in 2024. But I wanted to start off by wishing everybody, and my family is here to wish everybody Merry Christmas, Happy Hanukkah, and a Happy New Year. Say hi, everybody.
Hi. Merry Christmas. Happy Hanukkah.
Yeah, this is Lillian and Preston and Lauren. Some of you know Lauren because you've been listening to her music on Spotify for the Laughing Cats. So we appreciate that. You know, she's got 3 songs out now, so you can listen to all of them on her channel. And anyway, anything else? Anybody want to say anything to the Peter Schiff Show audience before I start today's podcast?
I love this man. I love him.
Lily?
Happy New Year.
You already said that. All right, there's little Presley's got his
Happy New Year, guys.
Dolphins shirt on. Unfortunately, we're probably not going to make the playoffs, but we will be rooting hard on Saturday for a couple of teams to lose. And then maybe the Dolphins can win 2 games and backdoor it into the playoffs. But it's like a long shot. But anyway, let me get into today's podcast. We got a lot to talk about. Everybody, remember to keep that door closed so I can get some quiet here in the office. But anyway, so the trading week came to a close earlier today. The Dow broke a 3-week losing streak today. Although it was a down day for the Dow closed down about 330 points off the lows, though. At one point today, the Dow was off about 550 points. In fact, all of the stock market indices were in the red today, but an otherwise positive week for the stock market. Gold was relatively flat on the week, maybe down a couple of bucks, although gold stocks did get hit again, down maybe 1.5%. I have a feeling there's probably some tax loss selling in those names because we did get a big drop in gold stocks in the last month or so since the election. And since, so many other stocks are up, maybe some people own some tech stocks that they sold and they wanted to offset the gains. And so they sold the gold stock. There are not that many stocks that were probably down. And the gold stocks were having a great year up until the election. Again, I think this is a head fake. I don't think the Trump presidency is bearish for gold. In fact, I think it's going to be bullish for gold. Not that a Harris presidency wouldn't have been bullish. That would have been bullish too. But I think Trump is also going to be positive for gold. In fact, gold did very well during Trump's first term. I think it was up about 40-50%. I think it'll have a bigger move during his second term. The dollar also, I think, eked out small gains. The bond market, though, continues to get clobbered. That, I think, is the bigger news story. In fact, if you look at the yield on the 10-year Treasury, it closed the week at 4.63. That's about the high of the week. And on a 30-year, we're at 4.82. We're almost 100 basis points above where we were when the Fed first cut. So the Fed has reduced short-term interest rates by 100 basis points, and that has had the opposite effect on the long end, where yields have risen by about 100 basis points. Now, again, this is exactly what I was forecasting was going to happen before the very first rate cut. And what's happening, fits my view. It's confounded just about everybody else. They're scratching their heads. They don't understand why rates are rising, and they're trying to, figure it out. But I think my explanation is much better and more likely to be true, given that I was, predicting this in foresight. I'm not trying to, reverse engineer it in hindsight. And the problem is the rate cuts are inflationary. The Fed aborted the tightening campaign too soon. It began easing well before inflation was back down to 2%. And it's obvious that it's headed higher, not lower. And you have an exploding budget deficit, all of which is pressuring the long end of the yield curve. And I've said that we're not going to see any relief. Long-term yields are going to keep rising until the Fed goes back to QE. I think even if we get more weak economic data, it still might not matter, because all the economic data that we got this week, and I'm going to go over that in a little bit, but all the economic news we got this week was bad news. And the bond market shrugged it off. It didn't matter. I mean, maybe if we get a big spike in unemployment or something like that, but even if that happens, which is probably going to happen at some point, I think any rise in bonds will be sold. Yields are headed much, much higher. And it's not just here. It's all around the world. In fact, it may be even more significant what's going on in Japan. Look at the 10-year Japanese government bond. I haven't talked about this in a while, but I talked about it quite a bit when the yields got up to 0.5%. And the Japanese government was kind of drawing a line in the sand, trying to defend the 50 basis point yield, because yields were lower. They went up to 50 basis points. And I was predicting that the Bank of Japan would not be successful, or the government, and yields would rise. Well, the yield now on the Japanese 10-year government bond is 1.1%. Now, that may not sound like a lot, but it's the highest since 2011. In fact, it's the first time since 2011 that you've had a one handle on the 10-year yield. Now, that's still very low, but when you have as much debt as Japan, it's beginning to be a problem. The 20-year yield is now at 1.88, and the 30-year yield is 2.27. These are all very low yields, but not nearly as low as they were. But I think what's more significant is if you look at the chart. And I think in 2025, you're going to see a doubling at least of the yield in Japan. I think the 10-year yield is going to move up to 2% from 1%. And what's going to be very significant about that is not just the added expense to the Japanese government of paying that, but I think once we get the yield above 2%, that's a huge breakout in the chart. And I think the move from 2 to 3 and 3 to 4 could be even quicker. And those are still low yields. A sovereign government borrowing for 10 years at 3 or 4% is still a pretty good deal, except it's not the deal that everybody is used to. In fact, what's been powering the risk markets, risk assets all around the world, is the yen carry trade, where people borrow cheap yen and then buy assets all around the world. Well, when the yield on the Japanese government bond rises above 2%, I think that's going to be the equivalent of a global margin call for the yen carry trade, meaning everybody's going to have to sell whatever they bought with their borrowed yen to pay back the loans. And this is going to pull the rug out from under a lot of other markets. And it's not just risk assets. I think the U.S. Treasury has been the beneficiary of a carry trade. And I consider the Treasury a risk asset, but a lot of people don't. I think what's happened is a lot of people have borrowed in yen and then bought U.S. Treasuries, loaning money to the U.S. government. And what's going to happen when they unwind that trade is there's going to be a lot more selling of U.S. treasuries. So what's happening in Japan isn't going to stay in Japan. It's going to reverberate. In fact, it could start off a tsunami throughout the world. But the reason that you're getting higher yields in Japan is the same reason you're getting higher yields in the U.S. It's inflation. It's debt. That's what's driving this train. And it's just getting started. So while all the experts are, still scratching their heads trying to figure out this, divergence, right? Nobody expected this to happen, least of all the Fed. Look at what's happening now to mortgage yields. We almost got down to 6% when the Fed started cutting. That first cut, we were down to like 6.1 on a 30-year fixed. Now I think we're back up to 6.85. I think by the first week of January, we'll be back with a 7 handle on the 30-year fixed rate mortgage. That is a very problematic level. It's already problematic now, but it's going to get worse, and it's not going to stop. And I think the treasury yields aren't going to stop when we hit 5. I think we're going to break through 5 early in January, especially if you look at what's going on with the debt problem. Donald Trump, actions speak louder than words. I hate to say I told you so, but I told you so. But in the first little battle about the debt, right, they had this continuing resolution that they wanted to pass. And the initial bill, was a much more voluminous bill. And at least to his credit, Elon Musk managed to put the kibosh on that one because he put it on X and he showed this monstrosity that they wanted to pass that nobody had a chance to read. And so they ended up passing something that was a lot smaller, but it still did a lot of damage because it still had 110 billion of additional spending. Maybe it had somewhat less than the original bill, but it still passed. And what Donald Trump objected to, he was demanding, along with Elon Musk, he was demanding that the Congress include in that continuing resolution a 2-year suspension of the debt ceiling so that they wouldn't have to deal with the issue and that the sky would be the limit on the debt over the next couple of years. Now, if Trump really was serious about doing something about the debt, he would want to leave that ceiling in place. I mean, that's the only tool we have to reduce spending. Not that it's worked that well, but I mean, that's the only thing that the Republicans have had up their sleeves is, negotiating the increase in the debt ceiling to try to exact some modicum of spending reduction. But if we've run up, over $36 trillion of debt with a ceiling, right, we're going to run up a lot more without it. Donald Trump didn't want that there. In fact, Donald Trump was out there saying that he wants to get rid of the debt ceiling entirely so that it doesn't even exist anymore. Again, that's all we got. Yes, it's a movable ceiling. If anything, we should make the ceiling fixed so it can't go up. But to try to get rid of it completely, again, if we have 36 trillion in debt with a ceiling, imagine how much more debt we'd have without one. But that's what Donald Trump wants to get rid of. Now, he claims he wants to take away the weapon from the Democrats, that the Democrats are going to wield that weapon. No, they're not. The Democrats don't want to stop the debt. They want to continue. It's only the Republicans who pretend that they care about the debt. And there are some actual Republicans who do. I'm not saying that there are no Republicans. There's a few of them there that have some integrity, but they're way outnumbered by the ones that don't. Anyway, we got a quick commercial break. Stick around. We're coming right back.
I love a great deal as much as the next guy, but it has to be easy. No hoops, no BS. So when Mint Mobile said it was easy to get wireless for $15 a month with the purchase of a 3-month plan, I called them on it. Turns out it really is that easy to get wireless for $15 a month. It's time to switch to Mint Mobile today and enjoy unlimited talk, text, and data for just $15 a month. In fact, when it was time to get my son Preston his own phone, Mint Mobile was the perfect choice. Forget about the steep monthly fees and overages that you get with your current wireless plan and make the switch to Mint Mobile's premium wireless plans, starting at just $15 a month. Choose any Mint Mobile plan, which includes high-speed data with unlimited talk and text on the nation's largest 5G network. You can even keep your current phone and number when you switch and bring over all your existing contracts. Ditch overpriced wireless with Mint Mobile's limited time deal and get 3 months of premium wireless service for $15 a month. To get this new customer offer and your new 3-month unlimited wireless plan for just $15 a month, go to mintmobile.com/gold. That's mintmobile.com/gold. Cut your wireless bill to $15 a month at mintmobile.com/gold. $45 upfront payment required, equivalent to $15 a month. New customers on the first 3-month plan only. Speed slower above 40 gigabytes on unlimited plans. Additional taxes, fees, and restrictions apply. See Mint Mobile for details.
All right. So also what was passed was the Social Security Fairness Act. And I talked about this act, but it passed. It got 100% of the Democratic votes in the Senate. It had already passed the House. So now, now it's done. But 27 Republicans voted in favor of it. Okay? So if 27 Republicans were willing to blow up the debt even more by increasing Social Security benefits. See, Social Security is already insolvent, right? Social Security right now is paying out more in benefits than it collects in taxes. And not only are they not reducing benefits, they're actually expanding them. The Fairness Act increases benefits for people who work for government, local governments, teachers, firemen, who they get a pension, but they also get Social Security. There's some rule that reduces the amount of Social Security benefits they receive. And I'm not even sure how it all works, but as a result of this Fairness Act, these people are going to get more Social Security benefits going forward than they were getting in the past. And people who weren't, collecting yet, when they do retire, because of this, they're going to get more money than was otherwise budgeted. So the deficit is going to go up. I think the number I read was maybe $20 billion a year. I'm sure that's way low, right? Every time the government estimates what something is going to cost, it's always much lower. The estimate is much lower than it ends up being. So if the government says this is going to cost us $20 billion a year, it's probably $50 to $100 billion a year, right? But I mean, who cares, right? Because the deficit is so big at this point that tens of billions here, tens of billions here, right? But the point is, we're heading in the wrong direction. And if these Republicans couldn't stand up against this increased spending bill, what luck is the Doge fake committee going to have in persuading an even fewer number of senators, which would be needed? I mean, it's going to be a great. They need all of them, and so they're not even going to come close to getting any spending reductions. Spending is going up, and that's why bond yields are going up, and it's ultimately, why the dollar is going to go down. I mean, the dollar has been strengthening, and one of the main arguments that I'm hearing to explain the strength of the dollar is the tariffs that are coming. We're going to get these tariffs. Well, we got tariffs when Trump was president the first time, and the dollar sold off after it initially rallied when he first won. His second year in office, the dollar, had a pretty big down year. I mean, so the dollar didn't make a lot of gains based on the first tariffs. But the idea that the tariffs are going to hurt the economies of our trading partners, that Mexico, Canada, they're all going to suffer from these tariffs. And so their currencies are going to go down. That's wrong. America is going to suffer more from the tariffs than any of our trading partners. I mean, our trading partners are going to be fine. Their sales to the United States aren't going to go to zero. Yes, their sales might go down. Maybe they'll go down 10 or 20%. I don't know. But they're going to get full price for the rest of their merchandise. And the stuff they don't sell to Americans, they'll just sell to the next highest bidder. Maybe that'll be China. Maybe, who knows? Maybe they'll consume themselves. But the fact of the matter is, the countries that are producing, they're in the driver's seat. If they don't sell to us, they'll sell to somebody else. They'll consume themselves. And what they lose is minimal, but what they lose, somebody else gains. Somebody in Canada, somebody in China will get to buy something that they previously couldn't afford because the American paid more. But because the American can't pay more because he has to pay a tariff on top and he got priced out of the market, that benefited the next highest bidder. It's the Americans who are going to have to figure out how to get by without the stuff that they can no longer afford. To the extent that there's some American substitute that's not as good, that's cheaper than the price of the import with the tariff, but that's obviously more expensive than what the import was without the tariff, well, then that'll be bought. But that's going to hurt the American economy, because if everybody has to pay more for imports, who buys imports, there's less money left over to spend on other things. And so whoever's supplying those other things, whether they're goods or services, is going to suffer. So this knee-jerk reaction is wrong. And in fact, I think to the extent that we piss off more people with tariffs and we make the U.S. market less viable for the rest of the world, that's another reason to move away from the dollar. That's another reason to stop supporting the dollar. So I think that these tariffs are not going to be good for the dollar. What's going to be bad for the dollar is going to be our rising budget deficits and our rising trade deficits. In fact, we got the merchandise trade deficit came out today. And it was supposed to shrink a little bit. This is the November number. It was supposed to shrink from 99.1 billion. Well, actually, it was supposed to grow. They were looking for 101 billion. Instead, we got 102.9 billion. That's a decent jump. That's only the fourth time in the history of America that we've had a merchandise deficit, a goods deficit in 1 month above 100 billion. The first two times that happened was in early 2022. And that was when the U.S. economy was just reopened from COVID. And we had all this backlog of goods that were sitting on the docks, but they couldn't come in because nobody was working. And so those were outliers. Those weren't real because there was all this pent up stuff. So we had smaller deficits for a few months and then, had a big rush of stuff coming in. But outside of COVID, the first time we had a deficit over 100 billion was 3 months ago. And now it just happened again. So 2 out of the last 3 months, we've had $100 billion plus goods deficit. So now they're no longer outliers. This is business as usual. This is where the bar has been reset. And these deficits are going to go up, even with the tariffs. The tariffs may reduce it somewhat, but I think there's a lot of upward momentum that you're still going to see larger trade deficits, even with the tariffs. Now, somebody when I posted something about this on X, somebody kind of tried to take me to task for blowing this out of proportion because he said that, well, as a percentage of GDP, the trade deficits are no bigger now than they were in 1985. Well, that's not true. I went back and checked, and the trade deficit, goods deficit in 1985 was 3.4% of GDP. The deficit we have right now is 4.6% of GDP. So it's much bigger. But I agree that we had a big trade deficit in 1985. That was a problem. We had a big trade deficit, growing trade deficit under Ronald Reagan. The trade deficit grew dramatically from 1981, when I think it was under 20 billion, to over 50 billion or 100 billion by 1985. I mean, it really was blowing out of control. In fact, we had small deficits in the late 1970s. Up until 1975, we had surpluses. So the first year we ever had a trade deficit was 1976. And then the trade deficits were growing slowly until Reagan. And then, we had these tax cuts, and Americans had a lot more cash, and the dollar had been strong, and Americans were going on a global shopping spree, and our trade deficit started to blow up. That was not, that did not go unnoticed in the markets, though. I mean, maybe that's something that this guy didn't realize. But so in 1987, January of 1987, the yield on the U.S. Treasury was about 10-year Treasury was about 7%. Right now, now I just said we're still below 5, we're like 4.6, right? But they were at 7. But because of the trade deficits that were growing throughout 1987, and they were growing in 86, right? They had been continuing to get bigger and bigger. They were putting upward pressure on bond yields. The 10-year Treasury by the summer of 1987 or early was up at 10%. So we had a huge move, and the dollar was getting killed. The dollar was falling as bond yields were rising. And the driving factor were these trade deficits that people were worried about. They were worried about the trade deficit in 1985, even though they're not worried about it now, and it's much bigger as a percentage of GDP now than it was then. At least back then, people were worried. And by 1987, they were really worried. And that is really what the catalyst was for the 1987 stock market crash, when the Dow dropped 500 points in one day, which, back then was a big deal. I mean, today we were down 500, and you don't even know. 500 in 1987 was like 20% of the value of the Dow, because the Dow was, 2,000 and something back then. But the trade deficit was so problematic. The markets were so worried about the trade deficit and the rising trade deficit that the bond market was tanking, the dollar was tanking, and then the stock market crashed. And my point really is that the markets have been asleep at the switch. So have the bond vigilantes, right? They've been completely MIA. Well, they're coming back, right? That's what's happening. Well, maybe they're going to start to worry about the trade deficits again and the budget deficits, right? The way they were in the past. And if that is the case, then that means we're going to get big problems. We had the stock market bubble in the 1990s and the tech bubble, and that popped. And then we had the housing bubble in the aughts, right? And that popped in 2008. We had the financial crisis. Well, the bubble we've got now is much bigger than both those bubbles combined. We got a bubble in stocks and a bubble in real estate, but we also have a bubble in bonds, even though the air is coming out of it. It's still there. We got a bubble in the dollar, for sure. We got a huge bubble in crypto. I mentioned that Bitcoin alone already has a bigger market cap than all the .coms that went bankrupt. All 400 .coms that were publicly traded that went bankrupt at their peaks weren't even worth as much as Bitcoin. Forgetting about all the altcoins, Ether, the other ones, all the stocks, MicroStrategy. 2 or 3 more companies have come out in the last week, and they've announced that they bought Bitcoin. They added Bitcoin to their balance sheet. Now, these companies all, in one way or another are related to crypto and stuff like that. So it's not, they're in the industries, but they're still taking cash and buying Bitcoin, and, the market is rewarding them. But, how many companies can do the same thing that MicroStrategy is doing? Because now they're getting a lot of competition in the we issue debt and buy Bitcoin business, right? That's their business. They're not a software company. They're in the business of buying Bitcoin and paying for it by issuing stock and debt. By the way, MicroStrategy stock ain't looking so good right now. It's now almost down about 40% from its peak, a couple of weeks ago, 2-3 weeks ago. And the last time they announced a buy of Bitcoin, and they announce it every Monday, so I'm sure we'll get another buy on Monday. But this Monday, they announced a buy, and their average price was like $106,000 for the Bitcoin. That was their highest print. And they only bought about another $500 million, which is still a lot to pay for nothing. But as I'm doing this podcast now, Bitcoin is barely hanging on to 94,400. So MicroStrategy is way off on that buy, but the technicals are really starting to break down. As a joke, because the thing that's been powering Bitcoin is
the fact that, they're going to be a Bitcoin reserve. Well, there's going to be no reserve, right? There's been no talk about that. I mean, it's not going to happen. But they got to keep the potential out there. So there'll be articles about it, but Trump has much bigger fish to fry. He's not going to waste any political capital trying to get this Bitcoin reserve done. So it ain't going to happen. And so at some point, the market's going to crash, because that's basically what's holding it up, is the fact that they think the government's going to come in with the big government bailout. But I joked and I said, look, if the U.S. government really wants to own 5-10% of a cryptocurrency, why buy one? Just start your own. The U.S. government can come out with its own crypto. Yeah, it can make a limit, hard cap at 21 million, no problem. Right? Just come up with your own and endorse it. And so I floated the idea, and I said, how about USA coin? And I had Grok, come up with a coin with a picture of Trump and Elon Musk on a gold coin that looks like the way they represent Bitcoin. And I said, hey, here's how it could look, right? This is how we could represent it. And let's call it USA coin. And, save the taxpayers some money. Instead of paying $100,000 for a Bitcoin, just, these could come out for pennies, whatever, just like Bitcoin did. And so instead of making the Bitcoin hodlers rich, just, save the taxpayers the money and just buy this new coin. What the hell difference would it make? I mean, because they could still use it. They could still dominate that coin. And in fact, if the U.S. government came out and said, hey, this is the coin that we like, and hey, we can't print it, it's hard capped at 21 million, we can make it legal tender. We could actually put it on a blockchain and make it capable of functioning, much better than Bitcoin, make it faster, make it cheaper, make it actually work as a currency. Yeah, why the hell not? I mean, not like I really want them to do it, but if they wanted to do it, I mean, sure. So I put it out as a joke. Your next thing I know, some guy actually launches one of these coins. It did like $10 million of trading in the first day. And as soon as I saw it, I had to go on and post, hey, don't buy this thing. I joked about it. Some of these Bitcoin guys don't understand sarcasm, or they just thought that they could take advantage of it and screw some people out of the money, which is what happens. But I've heard now there's another one coming out. There's a ICO. I don't know, but stay away from this. I mean, I try to back away from it or tell people not to buy it, that I wasn't serious. I said something like, Bitcoin is for losers, USA coin is for winners, hold it to the moon, whatever. Just all, the crypto nonsense. But they went out and created it. But the point I was making before I went off on that tangent is Bitcoin is a massive bubble too, right? And there are distortions. I mean, think about all of the capital that has been wasted on Bitcoin and blockchain related companies, right? That don't produce any products that we need, that don't generate any profits. They just generate returns for the shareholders because the price goes up because some idiot is willing to buy their stock. Meanwhile, the rest of the world is building real things, right? Making real stuff. That's one of the reasons our trade deficit is going up, is because instead of producing real goods, we're creating cryptocurrencies. And we're trying to figure out ways to gamble with cryptocurrencies while the world is making all the stuff that we actually need. And while we're talking about and we're encouraging our citizens to load up on Bitcoin, the rest of the world, the Chinese, they're buying gold, right? And so this is part of this huge bubble, this Bitcoin bubble and the stock market bubble and the housing bubble and the bond bubble. It is much bigger than what we had in the 90s and the 2000s. And because it's bigger, it's doing more damage to the economy. There are more mistakes. There are more malinvestments that need to be worked out now than there were back then. And making it even worse, all of this is happening at a time where the underlying structure of the economy that this bubble is built on top of is fundamentally weaker. We're in worse shape economically than we were in the 90s or the 2000s. We have a lot more debt now than we did then, right? So when this everything bubble pops, and it has to pop, the consequences are far more catastrophic than what we had in 2001 or 2008. Anyway, we got one more commercial. We're coming right back, so don't go anywhere. When you think about businesses growing their sales beyond forecasts like Feastables by Mr. Beast or even a legacy business like Mattel, sure, you think about a product with demand, a focused brand, and influence-driven marketing. But an often overlooked secret is actually the business behind the business that makes selling and, for the shoppers, buying simple. For millions of businesses, that business is Shopify. Nobody does selling better than Shopify, home of the #1 checkout on the planet, and the not-so-secret secret with Shop Pay that boosts conversions up to 50%, meaning way less abandoned carts and way more sales going. So if you're into growing your business, your commerce platform better be ready to sell wherever your customers are scrolling or strolling on the web, in your store, in their feed, and everywhere in between. Businesses that sell more sell on Shopify. What I love about Shopify is no matter how big you want to grow, Shopify gives you everything you need to take control and to take your business to the next level. Upgrade your business and get the same checkout that Mattel uses. Sign up for your 1-month trial period at shopify.com/gold. All lowercase. Go to shopify.com/gold to upgrade your selling today. Shopify.com/gold. All right, so I want to go over some of the weak economic data, again, that came out during the week, and nobody cares. I mean, part of the reason, I guess, that nobody cares is they assume that it doesn't matter, right? Because all these numbers are Biden's numbers, and as soon as Trump gets in there, it's all going to turn around. But it seems that most of the people in the financial media, and certainly the mainstream media, are still claiming that everything is great, that Biden is handing Trump a pristine economy. Remarkable was the word that Jerome Powell used to describe this economy, right? It's remarkable. And I think, again, they're setting Trump up because when the economy turns south, or it's actually already south, they just pretend it's north. But when they're forced to admit the economy's in recession, they're going to claim that Trump broke it, that everything was great. And look how quickly Trump ruined an awesome economy. It was remarkable, and he managed to wreck it in a matter of months. That's how bad Trump is. That's how damaging his policies are, that they created a recession before they were even, enacted, right? So that's what's coming, but they're still ignoring all of this data. I think that if we were getting this weak economic data without Trump, right, had Harris won, the dollar would be considerably lower right now. It would be lower than it was when we had the election, because the markets would have factored in this weak data, and they would have assumed that it was going to continue because, Harris would have been a continuation of Biden. So there would be no hope for change, right? Even though the hope we have now is mainly false hope, at least there's hope. But I think gold would be a lot higher. I mean, gold may even be over 3,000 by now if Harris had been elected instead of 2,600 where it's been hanging out recent this week. But anyway, so the news that we got, Richmond Fed manufacturing, that came out for December, -10. Again, a negative number. Not as bad as the November month number that was -14, but worse than the -8 that was expected. But again, manufacturing continues to weaken. These are the jobs that, Trump claims that he wants to protect. It's the industry that he wants to revitalize. Well, it's collapsing right now. And Biden had been taking credit for this manufacturing renaissance. In fact, every president talks about the manufacturing renaissance. We've been in the dark ages for manufacturing for the last several presidents. Even consumer confidence took a nosedive in December. I don't know where this came from, right? Because everybody had been excited about the election. So the prior month was actually revised up from 111.7 to 112.8. They were looking for 113 for December. Instead, it crashed all the way down to 104.7. That was way below the low end of the consensus. They were looking for anything between 110 and 115. So the election high is already wearing off, and Trump isn't even elected yet. Remember, I was saying that I think Trump could have one of the shortest honeymoons on record because the honeymoon could be over before he makes it to the altar, right? That the honeymoon is going to end before he takes the oath of office, right? Because so much has been built in. All this, the positive expectations, the rally in the stock market, the rally in the dollar, all this happened before he's done anything. And then when he finally gets to office, the markets are going to be very disappointed, I think, in what actually gets done. The next number I'm going to look at is Chicago Fed national activity. Another negative print, not as bad as the prior month, which was revised to worse. It was minus 0.4, and they revised it to minus 0.5. I'm not sure what they were expecting for November, but we got minus 0.12. But the 3-month moving average went up from an upwardly revised 0.27 to a minus 0.31. So again, another national index, Chicago Fed national activity, in recession territory, right? Again, markets had no reaction. Probably the weakest number that I would have expected some reaction to. The bond market didn't even care. Durable goods orders for November. A lot of times this moves the markets, right? They were looking for minus 0.2. We got minus 1.1. That's a big drop, especially from an upwardly revised up 0.8 in November. And transportation, we were down 0.1. We were supposed to be up 0.3. And so that was a weak number. And the core capital goods number, that one was actually better than expected. But the headline and the transportation numbers were much weaker. Again, but the bond market didn't care. Just shrugged it off. So we're getting more confirmation of what I already knew, which was that the economy was weak. Now, despite a lot of this weak economic data, oil prices were firm on the week. And in fact, oil closed the week above $70 a barrel. We're at $70.26. Now, that's still low. But if you look at the chart of oil, it looks to me like we're putting in a pretty good bottom in the oil market, just like we're putting in a top in the bond market. And I'm not talking about a short term. I'm talking about a major, significant bottom in oil and top in gold. And top in bonds, not top in gold. And this is not a coincidence that these markets are behaving the way they are, because the bond market and the oil market are very much a function of inflation. Inflation is bad for bonds and good for oil, right? Inflation drives oil prices higher and it pushes bond prices lower, driving bond yields higher. And that is exactly what's happening. And I know a lot of people are basing their optimism for the Trump economy on much lower oil prices, because they think that, well, we're going to have all this new production and that's going to result in much lower oil prices. Well, if we have much lower oil prices, we're not going to have a lot of new production. See, that's the problem. You can't afford to produce oil if the price goes way down. People are saying, oh, we're going to have $40 oil. We're going to have all this new production. If oil's at $40, no one's producing oil. They're going to lose too much money. In fact, if you look at the CapEx plans, oil companies are planning on spending less, not more, because the price is already too low. I do think that we'll have more drilling under Trump, but it's going to be because oil prices are much higher. That's what's going to support it. That's what's going to make the drilling possible, is going to be much higher oil prices, not lower oil prices. So we're not going to get a big tailwind of the economy from super cheap oil. Oil is bottoming out. So oil is going to start out, when Trump comes in, it's $70 a barrel. I think it's going to be well north of $100 a barrel when he leaves. In fact, it could move up to 100 during his first year. So that's going to basically take the wind out of the sail. And that's part of the
Treasury Secretary's, his 3-arrow plan that he's got borrowed from Shinzo Abe. But Scott Bessent, one of his arrows, or whatever he's called them, is cheaper oil. That's supposed to, keep inflation down. Well, it's not going to happen. And again, oil prices don't drive inflation. It's the other way around. Rising oil prices don't cause inflation, but rising inflation causes rising oil price or more inflation. Not right. The creation of inflation will drive up the price of oil and the price of everything else. And that's what's going to happen. But we're not going to get the cheap energy. We're also not going to get the spending cuts that he is hoping for. And, we're in fact, we're going to get the opposite. We're going to get increases. The main driver, just the interest cost on the national debt. And the problem for the government now is with long yields rising, now that the 10-year and the 30-year are all higher than the short-term rates. The Fed is not going to sell 10-year treasuries. They're going to be financing at the T-bills. And so what that means is that over the next couple of years, Trump is going to be considerably shortening the average maturity on the national debt, making that ticking time bomb that much bigger. Because ultimately, when the Fed loses control and has to raise long-term rates, which is short-term rates rather, which it's going to eventually be forced to do, that's going to be particularly problematic for the government because now so much more debt is going to be rolling over. And now it's going to have to be refinanced at much, much higher rates than, 4.5 or whatever they're financing it at now. So you're going to see the net interest cost exploding. I hear a lot of people, they think the debate is, Trump's going to create all this extra economic growth. We're going to have a stronger economy, and that's going to put the Fed in a difficult position because it's going to be putting upward pressure on inflation. And is the Fed going to hike rates in the face of the strong economy? I think they've got it half right. It's not going to be a strong economy. It's going to be a weak economy. The economy is going to be weaker. Yes, we're going to be spending more. There's no question that people will spend more, right? If we have increased government spending, if we have tax cuts, we're going to spend more. But we're not going to be producing more. The trends in manufacturing are going to continue. The trade deficits are going to get bigger and bigger. And so the real economy is going to be getting weaker, just like it's been in the past. What's going to strengthen is inflation. So it's not going to be that we have this booming economy and the Fed might hike. It's going to be that we don't have a booming economy, but the Fed might have to hike anyway because we have a resurgence in inflation. And in fact, it's very possible that even before we have a chance to get the tax cuts, that we officially go into recession. We could see a big move up in the unemployment rate. Now, the real question is, will Powell ease? Will he continue to cut rates to try to prop up the economy, even if inflation is headed in the other direction? Because nobody is talking about that possibility. Everybody just assumes that it's one or the other, that if we have a weak economy, well, then we don't have to worry about inflation. And if we have so the only way we have to worry about inflation is if the economy is stronger than expected. And people think that's still a problem. But what they're overlooking is the much bigger problem if we get stronger inflation and a weaker economy at the same time. And the reason that's the worst possible problem is, of course, it's the one the Fed has no contingency plan for, right? They admitted that. All they can do is hope it doesn't happen, because if it does happen, they're screwed. And of course, if they're screwed, the country is screwed, because there's nothing that they can do when they have a problem with both of their mandates at the same time. They like to say, look, we're trying to get full employment and stable prices, which they've redefined. In fact, I even heard Powell at a recent, his recent Q&A say that, Congress has given us these mandates for 2% inflation. Congress never gave the Fed a mandate for 2% inflation. The mandate is for stable prices. 2% inflation is BS. That's not stable prices. That's prices going up 2% a year. What's stable about that? Stable means they're unchanged. That's price stability. If Congress wanted 2% inflation, they would have put that in there. The Fed came up with 2% all by itself. It decided to define price stability as 2% inflation. So if it could define it as 2%, it could define it as 3% or 4%, whatever the hell it was. But that's not what it's supposed to do. But anyway, if it has this one mandate for 2% inflation, and then it has full employment, and it always wants to see, right now the unemployment rate is really low. And of course, it's only really low because of the way they calculate it. And the only reason inflation is low is because of the way they calculate. If they calculated inflation and unemployment honestly, the Fed would be failing on both mandates. You would see that unemployment is actually very high right now, historically high, and so is inflation. And so the Fed is a two-time failure. Instead, the Fed pretends that they've succeeded because they've rigged the game. But despite the fact that they rigged everything, unemployment and inflation can still be so bad that they can't hide it, right, between these numbers. And so once they get a spike in unemployment and a spike in inflation that happen at the same time, they got nothing, right? And they have to make a choice. They're caught between a rock and a hard place. And, when you hear people saying that, it's very rare to have recession and inflation at the same time, it's not rare. It happens all over the world. It just hasn't really happened in the U.S., in a big way since the 1970s. And part of the reason is because, we've changed the way we measure it. If we measured it correctly, we would have seen that we've had stagflation for a while in this country. But it is the norm. I mean, normally, when you have a weak economy, you get inflation, right? Strong economies don't create inflation, right? Why should a strong economy create inflation? Inflation is a bad thing. You don't get a bad thing from a good thing, right? That's what the government wants you to believe. But a strong economy is productive. You create more stuff. That lowers prices, right? Strong economies have high productivity. That keeps prices down. And if you look historically, you look around the world, you look at the strongest economies in the world, they have the lowest inflation rates in the world. It's the weakest economies that have the high rates of inflation, right? So inflation is a problem that weak economies face, not strong economies. Why do you have inflation in weak economies? Well, one thing, the economies aren't as productive. They're not making as much stuff. But why are economies weak? Generally because the governments are too big. They're spending too much. So they're printing too much, right? They're running deficits. Governments create inflation, and inflation weakens an economy. So you normally have inflation and a weak economy at the same time. It's not some rare combination that rarely happens. It's the norm. And so that's what we're going to have. And again, it's far more common than all these Keynesian economists believe. And that's why their investment strategies don't make sense at all. Everybody is betting on an outcome that's not going to happen, and they're completely ignoring the outcome that is going to happen because they just dismiss it out of hand. But again, these are the same people that didn't know there was a stock market bubble, didn't know there was a housing bubble, and so now they don't know that there's an even bigger bubble. There's an everything bubble. Everything's in a bubble except gold stocks, right? Or gold. I mean, the things that people should be buying are the only things they're not. You have like a reverse bubble there. And all the things that are, at the center of the bubble, that's what everybody's buying. Everybody is piling in to these bubble assets, from tech stocks to cryptocurrencies, while they're ignoring the out of favor assets that will come into favor, I believe, as the air comes out of this bubble, one way or another. And I think the most likely way that it comes out is with massive inflation. I think you see a big decline in the dollar, and so you get real declines in asset prices more so than nominal, meaning it's not the Dow crashes, real estate prices crash, it's that the dollar crashes. And so asset prices are reduced more in real terms than they are in nominal terms, although we could have a little of both. But I think ultimately the greater damage is going to come from the inflation side, because that is the most politically expedient path to follow. And so unfortunately, that's where we're headed. I think it's going to be, good for the portfolios that I manage and for my investment strategy. That's why I have it. But it's not the outcome that I hope for. It's not the outcome that I want. It's not the outcome that I advocate for, but it's the outcome that I expect. and it's the one that I prepared for. Anyway, that's it for today. I'm not sure if I'm going to do another podcast, as I said, in 2024. I'll see what happens next week. I've got some plans. I'm traveling. I'm going to be up skiing in Canada, trying to take advantage of the weakness in the loonie, get a better deal up there on the hotel and the lift tickets. I haven't skied up there before, so I'm going to give it a try. Last year we were out in Colorado, so I'll try skiing up north. Hopefully it's not too cold, and then we will be headed directly back to Puerto Rico, where I'll be able to warm up in 80+ degree weather. And I'll continue to do my podcast. My plan is to stay put in Puerto Rico for a while, maybe until the kids finish up. You met the little kids earlier. They're in elementary school, so I'll probably stay put until they're out of school in May. Anyway, again, I want to thank everybody. It's been a hell of a year. Got the podcast number 1,000 last week. It's going to take a while for me to do another 1,000, but I'm sure I'll do it. Hopefully the people who are listening now will still be listening then. My guess is that most of my forecasts will have come true by the time I do podcast number 2,000. But anyway, I really appreciate everybody tuning in to these podcasts, listening live. And then those of you who can't listen live, who end up hearing the podcast, a day or two later, really appreciate the fact. Again, remember, if you're not yet subscribing to Schiff Sovereign, sign up for that newsletter. We got a lot of new content, I think, that's coming out next year. We got some plans for the letter, a lot of new stuff coming out of that. So make sure you sign up for the free newsletter at schiffsovereign.com, and try out the premium products as well. They're well worth the money. There's a lot of good content there that we provide. Again, hopefully everybody has a happy new year, and I wish everybody a healthy and happy 2025. Bye for now.